I think right now, yeah, I think all the indications that we get are that retail spending is strong, and for the first time, we're starting to see an uptick in the percentage of consumers that want to spend more in the U.S. The recovery has been sort of governed by fewer people wanting to spend less. Actually, that's been what's been driving a lot of the growth. So right now, I think we're in a good place. The one thing we always watch a little bit is from a consumer sentiment point of view. When people feel really good about today, but less good about tomorrow, most people would save. Americans tend to spend like sailors on leave. So the problem you have right now is that that's kind of that consumer sentiment thing that you're getting right now. So we're a little worried about that.
So is it fair to say that the forward or the anticipated outlook by consumers is maybe tailing off a little bit? And is that something to really worry about?
It's just that the gap between where they see today and where they see tomorrow is getting bigger. And that's mostly caused by people feeling better about today.
Are you feeling that, Chad, as you look at the markets the way that you do? Do you feel as though the consumer is maybe showing some signs of fatigue? Is maybe not the right word, but are they pausing a bit now, given what we've seen in the economy and perhaps the uncertainty around U.S.-China trade?
Well, it depends on what you're classifying as the pause. So housing is slowing down. Mortgage credit seems to be decelerating modestly. Those are the major big-ticket items, as well as auto sales, as you could tell, is stuck in the mud. But you could see consumption patterns for the big-box retailers has been quite robust. Hence the reason why, well, the reason why is because you have full employment, you have a modest increase of salaries and whatnot. Most of the concern that we see is external factors coming from China as well as the European Union. And we are seeing, though, a deceleration of economic growth here.
Where is that playing out more markedly, Chad, in the markets right now?
Oh, on the fixed income side, you could see that the yield curve, a lot of that behavior is coming from external factors, concerns about European growth, in deflationary pressures overseas. Here in the United States, we are growing. It's not robust at a 2% handle, and we believe next year you can see a continuation of a deceleration.
So, Bryan, I mean, growing is the key operative word there. The U.S. economy is growing, and it's better than many other places around the world right now. Two fascinating reports this week, Home Depot and Lowe's, both of them showing some signs of strength. Chad brings up housing.
Yeah.
In the past, the American consumer has used the house and home equity as a piggy bank, and they've gone out and spent to improve and do everything else. Are we seeing that play out a little bit more? Do you think the consumer is going to be tapping that piggy bank in home equity to go out there and continue this economy?
I think to some degree. I think it's always important to remember the majority of Americans don't own their own home. So it's important to just frame it with that. I do think with Home Depot and those, so if you look at those businesses historically, they tend to move more in parallel rather than in inversion to each other. So if you look at the performance over time, they seem to get impacted by the same factors. They're very economically sensitive. The one difference, though, Home Depot has more exposure to the pro market, though Lowe's called it out as an area of growth. So if their outlook is a little cloudy and Lowe's is less cloudy, that may indicate, to Chad's point, that you might see some uncertainty in the housing market rather than in the consumer side of the housing market, like remodels. So if you interpreted that data, you could say that, wow, the consumer's feeling pretty good, but home building may not be as accelerating as quickly as it might have in the past.
So Chad, from your portfolio manager, where are the opportunities and where do you stay away from, given that kind of outlook for the consumer and the U.S. economy?
So we would actually be overweight consumer staples, consumer discretionary, only certain companies on that side. In regard to the fixed income market, we would invest in high-quality bonds. We would underweight low-quality bonds like high yield. We don't think you're getting paid well for taking on the risk. And we'd stay more dollar-centric with our asset allocation. So be overweight the U.S., underweight emerging markets,